Welcome to The Explainer. Today, we're tackling a major financial puzzle coming out of China. It's a story of bank stocks that are absolutely booming, all set against a backdrop of some pretty deep economic anxiety. On the surface, this makes absolutely no sense. Normally, banks are a mirror for the economy. When it struggles, they struggle. But in China, we're seeing the exact opposite. So let's dive into this apparent contradiction. It really is a great divide. In one corner, you've got the stock market, where shares of China's huge state-owned banks are hitting highs we haven't seen in years. And in the other corner, you have the real economy, which is grappling with a property crisis, really weak demand, and even deflation. So what on earth is causing this split personality? To understand this rally, you really have to look beyond the typical financial metrics. It all starts with the powerful story the Chinese state wants investors to believe. It all starts with this phrase right here: valuation with Chinese characteristics. Now, this isn't just some clever market jargon. This is a top-down policy directive. The government is essentially telling the market, hey, you've been valuing these banks all wrong. Stop looking at them like simple commercial companies. You need to start valuing them as core pillars of our national strategy, backed by the full faith and credit of the state. It's basically a command to rediscover their value. The core argument for this whole revaluation comes down to one key number: the price-to-book ratio. China's biggest banks look incredibly cheap, with a ratio of around 0.7. What that means is their stock price values them at just 70 cents for every dollar of assets they officially own. Now compare that to a giant like GT Morgan, which trades at over 2 times its book value. For the bulls, the people buying in, this isn't a red flag. It's a massive flashing buy signal. And the second pillar of this bull case is the dividend. These state-backed banks are paying out a steady 6 to 7% every year. In a world where investors are just starved for yield, a number like that acts like a powerful magnet, making these stocks feel almost as safe as a high-yield bond. Okay, so the stock story, that state-sponsored narrative, it looks great. But if we peel back that layer and look at the actual day-to-day business of banking, well, the picture changes pretty dramatically. The single most important number for a bank's core profitability is its net interest margin, or NIM for short. Think of it as the bank's fundamental profit margin on its main business, lending money. A healthy, growing NIM means a healthy, growing bank. And that core profitability? It's in crisis. Net interest margins for Chinese banks have collapsed to historic lows, and they're still falling. So why is this happening? Well, the very same state that's boosting their stock prices is also forcing them to lend cheaply to prop up the economy. Their national duty is actively eating away at their profits. But the profit squeeze isn't even the biggest risk. There are these potential time bombs just ticking away on the bank's balance sheets. Risks that the official numbers don't fully capture. Officially, if you just look at the headline number, everything looks fine. The reported bad loan rate for the entire banking system is a very healthy 1.5%. That suggests that for every $100 loaned out, only $1.50 is in trouble. On the surface, that looks incredibly safe, but that overall average can be really misleading. It's kind of like checking for a fever by averaging the temperature of your head and your feet. So what happens when they isolate the single riskiest sector, that cratering property market? Well, according to an analysis from S&P Global, the reality is much, much starker. They predict that the real bad loan rate just for loans made to property developers will surge to 6.4%. That is more than 4 times the official overall rate. This is where the real damage is hiding. And beyond real estate, there's another, even more opaque black box of risk. We're talking about billions upon billions loaned to something called local government financing vehicles, or LGFVs. These are basically off-the-books borrowing tools for local governments, often backed by land sales that, well, aren't happening anymore. The debt is massive and unclear, but one Moody's analysis suggested that if these LGFVs start to fail, they could push the entire banking system's bad loan rate into the 8 to 12% danger zone. So we're left with 2 completely different, conflicting stories. You have one story of state-backed strength and another of fundamental, hidden weakness. So which one do you bet on? It really boils down to a pretty simple choice. The bull case is a bet on state power. It's a bet that Beijing can manage the crisis. and that those high dividends will keep flowing. The bear case is a bet on financial gravity, a bet that squeezed profits and hidden bad debt will eventually overwhelm any state narrative. At the end of the day, the losses from the property bust in local government debt are real. They exist. The question isn't if they'll hit, but who will pay for them. Will it be the banks, the state, or the taxpayers? And when will that bill finally come due? As a slow burn over a decade, or as a sudden, sharp shock? So are these cheap, high-yielding bank stocks the greatest value trade in the world right now? Or is this rally just a fragile, state-sponsored bubble floating over a sea of bad debt just waiting for a pin? The answer is going to define China's economy for years to come.